Okay, been asked to make one about the financial and capital account, the balance payments. The truth is that you don't need to know a whole heap about this. So when you look at the syllabus, it just says, well, kind of detailed understanding of the components of balance payments isn't strictly necessary, or isn't required. But we've used this as an evaluation for current account surpluses and deficits, and somebody just wants me to go through it again in a bit more detail. So, a financial account. So what's in the financial and capital account? If you take those two things together, there are really kind of three things that are in it. Kind of short-term inflows, that are going into the So really, and outflows, of course. So really, it's about hot money here. Kind of cash inflows into the banking system and so on. You've got something that's called portfolio investment, where you're buying things like bonds, shares, property, that type of stuff. And then kind of long-term investment, physical investment, which is FDI. I mean, there's more things that go into it than that, and nobody's going to ask you about the differences between this for our purposes. But basically, what we're looking at is one-off investments that are going to make some sort of a return in the future. That's what's appearing on the financial and capital account. And the ways in which we talked about this, we've looked at it from the point of view of a country like China. China has a large current account surplus, and for reasons that I've explained elsewhere, that means it'll have a financial account deficit. So China has a financial capital account deficit. What does that mean? What it means is that China is investing abroad. So the surplus funds are being invested around the world. The same would be true for Norway, which has a large current account deficit, a large current account surplus. The money that's generated is then invested abroad. In the case of Norway, we know that they have a large sovereign wealth fund. They own something like about 1.5% of the world's companies, because of the surplus income that's come from oil. In the case of China, some of that is lent, some of that goes into the US. So it's kind of surplus funds that go into kind of US bonds. Some of it has gone into a whole variety of foreign direct investment, loans, that type of stuff, that's gone to the continent of Africa, to countries there. So what does that mean for these countries? What it means is that they're building up a stock of assets abroad, and those assets are then going to give them both income gradually. So China is getting income from US government bonds. Norway is getting dividends from the shares that it owns around the world. China is getting returns from the businesses and from the loans that they've made inside Africa. And in some cases, it gives you soft power. It gives you the ability to influence, because you have a lot of investment into an economy. It gives you some say, some way of influencing the government of that economy. The way we've tended to talk about it more often, though, is the other way around, where we're talking about a country like the UK that has a large current account deficit. What that means, as we've explained, is that somehow that has to be financed, and that comes in the form of a financial account surplus. So, and whether a financial account surplus is good or not really depends on its composition. And if we take each of the different elements that there might be, then you can kind of each has most of them have upsides and downsides. So one way in which it might be your financial capital account, your capital financial account surplus, might be hot money. So it might be short-term funds coming into your banking system. By and large, that tends not to be particularly helpful. I mean, it is giving short-term liquidity to the system, but in reality, what it's doing is, it's volatile. It can go away, and it means that your exchange rate, can quickly rise and fall, and that creates instability and problems for businesses. So if it's primarily hot money flowing in and out of your banking system, it's not particularly great. It might be that the money, the financial investment from abroad is going into bonds. Investors from other countries are buying, if we take the UK government bonds. What that does is it's going to lead to an increase in bond prices. It's going to lead to a decrease in their yields. So what that's doing is it makes it easier for the government to finance itself, because there are lots of buyers of UK government bonds. So if the UK government has a budget deficit, then what it's finding is there are lots of people who want to invest into financial assets in the UK. That makes it easy for the government to be able to borrow, which is a good thing, and it can borrow more cheaply. Obviously, the drawback is that the interest payments on those loans, those interest payments go abroad, and what that's going to do is it's going to further worsen the current account, because that's then a primary income flowing out of the economy, and therefore it's worsening your overall current account position. A similar story could be told. Of shares. So it could be that the financial account surplus is coming in the form of shares. What that means is that overseas investors are buying shares in UK companies. So in UK PLCs, UK companies. So on the one hand, that does lead to an increase in share price. And again, similar to the government, that makes it easier for companies to finance themselves. I mean, that money's not going to the companies. They're not buying share. They're not buying new shares. They're buying shares from existing shareholders. But nevertheless, if the company wants to issue new shares, the higher share price makes it easier to do so. So it's easier for companies to sell more shares, to raise what's called equity finance. But again, the drawback obviously is like the reverse of the Norway position. The dividends on these shares are being paid. Dividends leave the economy. So profits are repatriated, sent back to where they came from, to the owners of these countries, and therefore, again, that's going to worsen the current account in the longer term. A fourth way in which you might have a current account surplus could be in the form of property purchases. So in lessons we talked about how buildings in London, like the Shard, the Gherkin, the Walkie Talkie, and all these sorts of places, tend to be owned by foreign investors. Really, what that's doing then is it's leading to an increase in property prices, which then spills through to house prices, which isn't great because it's pricing people out of markets. It may then have an impact on rent, which may increase, and any rental income or income from these properties goes abroad. None of that is particularly good news. So money flooding into the property market is just creating a property, and obviously it's creating the risk of a housing bubble, because so much of this money's coming in. And then lastly is something we've probably touched on elsewhere, which is what it might be. It could be foreign direct investment. It could be businesses. It could be overseas businesses like Amazon coming and setting up fulfillment centres in the UK. And then whether that's good or bad is fairly complex. On the one hand, what it's doing is it's an increase in it's an actual increase in investment in the UK. Somebody has to build these fulfillment centres, so that's going to increase aggregate demand. It has an impact on infrastructure, so it's likely to, in model terms, increase both aggregate demand, aggregate supply. It's likely to create jobs. It could lead to competition, leading to greater levels of efficiency and growth, and so on and so forth. But obviously, there are then the downsides of foreign direct investment, which again is the repatriation of profits. It's possible that actually we've talked about jobs being created, but kind of excess competition could reduce jobs. We talked about China. We talked about the idea of soft power, that you become dependent on this foreign investment, or in some places the foreign, depending on the extent to which you can enforce laws, it's possible that foreign companies will have less respect for the environment or for labour laws than domestic ones might. So taking the financial account as a whole, then it's just the flip side of the current account. When you're looking at it, it's a deficit means that overall you're investing abroad. A surplus means overall you're being invested in, Whether that's good or bad really depends on the nature of those financial and physical investments.